Welcome to today's deep dive on the 529 Superfunding strategy. First, we will explain how the 5-year gift tax election lets you accelerate up to 5 years of annual exclusion gifts into a single-year contribution, jump-starting tax-free growth for college. Next, we will break down the numbers, the filing requirements, spousal tactics, and the pros and cons so you can decide if this approach fits your plan. Finally, we will end with a couple of quick quizzes, key takeaways, and a helpful disclaimer so you can follow up confidently with your tax and financial advisors. To set expectations, here is our agenda. First, we define superfunding and the 5-year election. Then, we move into a decision flowchart and a timeline. After that, we compare the math between superfunding and annual contributions. Next, we cover spousal strategies and gift splitting. Then, we walk through tax filings and state-specific considerations. After weighing pros and cons, we will quiz you with a couple of quick questions. Finally, we close with key takeaways and an important disclaimer. Let's begin with a definition. Superfunding is a special 5-year election that allows you to make a large, one-time 529 contribution equal to 5 times the annual gift tax exclusion per donor for one beneficiary. When the annual exclusion is $19,000, one donor may contribute $95,000 in a single year and elect to treat it as though it were made evenly over 5 years. Married couples may be able to double this amount to $190,000 using gift splitting or by each spouse making their own 5-year election. The core benefit is earlier, tax-advantaged compounding. The key compliance step is filing IRS Form 709 to elect 5-year averaging. Considerations include liquidity needs, financial aid impact, and state-specific tax rules. Now, let's understand the mechanics. The annual gift tax exclusion per recipient is assumed to be $19,000 for the current context, but you should verify the current year's figure. Under the 5-year election, one donor can contribute 5 times the annual exclusion amount in a single year to a single beneficiary's 529 account. That equals $95,000 when the exclusion is $19,000. To implement this properly, you must file IRS Form 709 in the year of the large contribution and elect to spread that gift evenly over 5 years. If you make additional gifts to the same beneficiary during that 5-year window, those additional amounts may exceed your annual exclusion and will start to use your lifetime gift and estate tax exemption. For married couples, you can consider gift splitting to reach $190,000 in 1 year, or use a selective approach where only one spouse uses the 5-year election so the other spouse retains their annual exclusion for ongoing contributions without penalty. Remember that 529 earnings are federally tax-free when used for qualified education expenses. Many states conform, but rules vary, so it is important to check your plan. Given the rising costs of higher education, front-loading can position you for substantial undergraduate and graduate expenses. Next, visualize the decision process. We start by asking if you have at least 3 to 5 years before you need to withdraw funds. If not, a partial superfund or annual contributions may be more prudent. If timing is sufficient, we check whether you have adequate cash reserves and an emergency fund. If not, maintain liquidity and revisit later. Then, we consider need-based aid. If aid is a significant factor, you might prefer gradual funding, or evaluate a grandparent-owned 529 under current FAFSA and CSS profile rules. If aid is less relevant, we confirm your readiness to file Form 709 and track the 5-year averaging. If you are not prepared to manage the paperwork, engage a tax professional. If you are ready, proceed with the 5-year election, set reminders to monitor the 5-year window, and review state-specific rules. Let's compare simplified math. Assume a constant 6% annual return and that funds are used for qualified expenses. A one-time $95,000 superfunded contribution, compounding for 15 years, grows to roughly $227,600. By contrast, contributing $19,000 at the start of each of the first 5 years, and then letting it grow to year 15, totals about $193,900. The difference, approximately $33,700, reflects the benefit of having more money invested earlier. For a married couple using $190,000 in year 1, the amount after 15 years under the same assumption is approximately $455,200. These are illustrative estimates only. Actual returns, timing, fees, and plan selection will change outcomes. Now let's zoom in on spousal coordination. First, each spouse can contribute $95,000, and each file Form 709 with the 5-year election, for a combined $190,000 to one beneficiary in 1 year. Second, one spouse might superfund while the other preserves their annual exclusion for ongoing contributions. Third, one spouse could contribute the full $190,000 if they use gift splitting, with the other spouse's consent documented on Form 709. During the 5-year averaging period, any additional gifts to the same beneficiary by the same donor can exceed the annual exclusion and will begin using the donor's lifetime exemption. Proper coordination helps avoid unintended use of lifetime exemption and can optimize any state-level tax deductions or credits. Consult your tax advisor to select the best approach for your situation. Moving into execution, start by defining your education goal, time horizon, and budget. Next, compare your state's 529 plan with alternatives, considering fees, investment choices, and any state tax advantages. Then, open or verify the 529 account and ensure the correct owner and beneficiary are listed. After that, make the lump sum contribution and maintain clear documentation. Importantly, file IRS Form 709 for the Superfunding year and elect 5-year averaging. If gift splitting is part of your plan, complete that section as well. Subsequently, track all gifts during years 2 through 5 and coordinate with your spouse to avoid exceeding exclusions. Then, review investments and potential financial aid considerations annually. Finally, when it is time, withdraw for qualified expenses under the 529 rules. To place this in time, begin in year 1 by opening the 529, contributing the lump sum, and filing Form 709 to elect 5-year averaging. In years 2 through 5, any gifts to the same beneficiary by the same donor are measured against the annual exclusion and the election. Additional gifts may use lifetime exemption. By year 6, the 5-year window is complete, and your annual exclusion fully resets for that beneficiary. During college years, you can take qualified withdrawals as needed, and throughout, you should review investments, state rules, and potential aid implications on an annual basis. Turning to taxes and state benefits, always file IRS Form 709 in the Superfunding year to elect 5-year averaging and to document any gift splitting. Making a Superfunding contribution does not cause immediate gift tax. Instead, amounts beyond the annual exclusion use a portion of your lifetime gift and estate tax exemption, which Form 709 tracks. If you are funding a grandchild, or otherwise skipping a generation, review the generation skipping transfer tax rules and any required elections. State income tax benefits vary. Some states offer deductions or credits with annual caps, and some allow carryforwards, while others offer none. Non-qualified withdrawals can incur taxes and penalties, and qualified expense definitions vary across federal and state rules, including treatment of K-12 tuition. Under Secure 2.0, in certain cases, leftover 529 funds may be eligible for rollover to a Roth IRA for the beneficiary, subject to account age, annual contribution limits, and lifetime maximums. Financial aid treatment has changed under the new FAFSA. Verify current rules and understand how parent-owned versus grandparent-owned accounts may affect eligibility, and how the CSS profile treats these assets and distributions. Weighing pros and cons, the advantages include earlier compounding on a larger base, federally tax-free growth for qualified expenses, potential state tax benefits, simpler future gifting cadences, and the ability to address rising tuition and graduate school costs. On the other hand, the trade-offs include reduced liquidity due to the large upfront contribution, administrative work such as Form 709 and tracking, potential impacts on need-based aid depending on ownership and evolving rules, market and investment risk, and the possibility of state rule complexities or recapture if funds are misused. Balance these factors against your goals and risk tolerance. To reiterate the math, assuming a 6% annual return over 15 years, a single $95,000 contribution compounds to approximately $227,600, contributing $19,000 at the start of each of the first 5 years, and then letting it grow, produces about $193,900. The roughly $33,700 difference results from having more principal invested earlier. For a married couple contributing $190,000 up front, the amount after 15 years would be about $455,200 under these assumptions. These examples are illustrative only. Actual experience will vary with returns, timing, fees, and plan rules. Quiz time. The question is, how much can an individual contribute in a single year under the 5-year 529 Superfunding election when the annual exclusion is $19,000? The options are $19,000, $38,000, $95,000, or $190,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $95,000. 5 times the $19,000 annual exclusion equals $95,000 under the 5-year election. Here is your second question. Does making a superfunding contribution immediately trigger gift tax if you exceed the annual exclusion? Your options are: yes, taxes due right away; no, you file Form 709 and use lifetime exemption; only if the 529 earns more than 10%. Or only if the beneficiary attends a private school. You may pause the video now to consider your answer. We will review the solution in the following section. The correct answer is no. You file Form 709 and the excess over the annual exclusion uses a portion of your lifetime gift and estate tax exemptions. Gift tax is typically due only if your cumulative taxable gifts exceed your remaining lifetime exemption. To summarize the core points, Superfunding accelerates tax-advantaged compounding. You must file Form 709 in the year you superfund to elect 5-year averaging. Coordinate with your spouse to decide between individual elections or gift splitting, and to optimize the $95,000 and $190,000 strategies. Review state rules, financial aid implications, and any generation-skipping tax considerations. Front-loading can significantly boost the long-term education funding plan amid rising costs. Before we conclude, an important disclaimer. This content is for educational purposes only and does not constitute tax, legal, or financial advice. Verify current federal and state limits, plan rules, and financial aid treatment before acting. Contribution limits, annual exclusions, and lifetime exemptions change over time. State tax deductions or credits and recapture rules vary. Investment returns are not guaranteed, and you can lose money. Qualified expense definitions differ by jurisdiction. Gift splitting requires proper consent and filing. For grandparent-owned or trust-owned accounts, confirm current FSA and CSS profile treatment. Consider Secure 2.0 provisions and any 529 to Roth IRA rollover requirements. Consult a qualified advisor to tailor decisions to your situation. As we wrap up, remember that Superfunding is a 5-year gift election that enables a one-time boost to a 529. With an assumed $19,000 annual exclusion, one donor can contribute $95,000. Married strategies can reach $190,000 through splitting or dual elections. Filing Form 709 is essential to document the election. Over long horizons, front-loading often outperforms annual contributions due to earlier compounding. Finally, always verify current federal and state rules, potential state benefits, and financial aid impacts before proceeding. Thanks for watching. If you found this helpful, please like the video, share it with someone planning for education costs, and subscribe for more practical finance guides. In the comments, tell us how you might use a superfunding strategy and what questions you want us to cover next.